Welcome to GRE. I'm your host, Keith Weinhold. The housing supply crisis just deepened. How far has home inventory plunged? I've got answers. Today, we learn from a case study with a housing developer and how you deal with today's builder risks as America tries to build our way out of the crisis. Today on Get Rich Education. A lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both. Jacksonville, Florida, with 27% lower home prices than the national median and 1% higher rents, their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and appreciation for tomorrow. They often have available inventory in Jacksonville. Start at cashflowandgrowth.com. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from St. Simons Island, Georgia to St. Albans, Queens in New York City and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Over the past year, Redfin has just reported that median home prices have now soared 18%. Year over year. And that's up to a median of $356K. Remember, a lot of higher price homes are selling, skewing the median up higher, but that is still pretty remarkable. In fact, homes sold in March were only on the market for a jaw-droppingly short 21 days. Again, that's per Redfin. So inventories plunged for the first 3 months of this year. I think it can best be seen really in the Federal Reserve's active listing count. They are the stats that I keep citing here, so I'll stay consistent. Now, typically in the last 3 to 5 years, we've been in this range of 1 million to 1.5 million homes available. Well, in the first 3 months of this year, we saw just 600,000 available homes for sale in January. So already just half of the historic norm there. And then in February, it fell further. It fell from 600,000 down to 523,000. So that's a substantial month-over-month plunge right there in itself. And the March data, that's still the latest data that we have numbers for. There is that lag in real estate. Would it go under 500,000 in March? Could it go under 500,000 available for sale homes in March? And it did. Just 493,000 by the end of March. And by the way, that count, that includes detached single-family homes, condos, and townhomes. The April numbers are not in yet, but available homes almost seem as scarce as a rare earth mineral at this point. It is going to take years to catch up. I'm talking about years until supply comes back into balance with housing demand. That is pretty predictable, really, because it does take a substantial amount of labor and materials and land, and therefore time, to build a home. But see, this plunging inventory, though it's reached greater depths, it's not a new story. But what is a new story developing now in this torrid market is that high demand is now a direct cause for the low inventory. That independent variable of high demand is becoming more apparent. Now, Redfin's chief economist Daryl Fairweather recently summed up the housing demand sentiment pretty succinctly recently as we approach the fact that close to 40% of U.S. adults have now been vaccinated Well, there was a question in the market about whether fear of pandemic infection was actually keeping some homeowners from selling because they didn't want strangers coming through their homes. Well, with us still having so few homes on the market here in the month of May, see, it is becoming increasingly apparent now that people don't fear contact with strangers really as much as their fear of not having another home to move into if they sold their existing home. And increasingly, that is the sentiment that is driving the demand separate from the low supply portion. It is that demand that's coming from people saying things to themselves like, gosh, if I've already got a house here that I live in and own, I feel fortunate, I feel safe, and I'm not going to move. That right there is part of the problem, the crisis of this housing shortage. So with that challenge in mind, let's talk about some solutions. The most innate solution to a shortage being, of course, building new construction homes. And over the next few weeks here on the show, I'm going to talk to some different housing developers and real estate analysts about addressing this crisis in at least three ways here. First, with what we're discussing today, it is about converting raw farmland into new homes. On future shows, I'm going to talk to a developer about how they're converting shipping containers and building homes out of those. And then also, we're going to discuss 3D printed homes to help get us out of this housing crisis that is going to drag on for years. Now, understand that all three of those home build types that I just mentioned, conventional new build homes, shipping containers, and 3D printed homes, they all still have major input costs of labor and materials and the cost of land. All three of those types have all of those major inputs. And that fact is why conventionally built homes are still the way it's done and still the way that the majority of construction is going to continue to be done for quite a time here. Yes, so we're talking about building a home on site, not fabricated in a plant off site. Today, we're essentially looking at a case study of this raw farmland being converted into hundreds of new construction homes. We look at market selection, site selection, and I really want to talk to the developers so that we can learn about some of the risks today, like how you handle all these supply chain disruptions and price spikes in commodities like copper and lumber. How does a developer deal with that risk? Before we do, just a reminder that you can find GRE on all of your favorite social media channels. We are at Get Rich Education on YouTube, Instagram, Facebook, and TikTok. On Twitter, we are simply Get Rich Ed. That's due to a character count limit there. But yes, I guess consistently branded as Get Rich Education across all of your favorite podcasting platforms and social media platforms, helping you get financial freedom through real estate investing. Hey, do you have a friend that still doesn't know about podcasts? Can you believe those people exist? Yes, those people are still out there. Just have your friend download then the Get Rich Education phone app, and they can listen there. Everyone knows how to do that. If you want to get some more income property in your portfolio, the place to start is at greturnkey.com. Yes, there is actual inventory with many of the providers at our sister site there, which is where I do my own property buying myself. I have bought my last several properties right there at greturnkey.com. Let's get more on the construction development angle in meeting the housing shortage crisis today. Rob Fuller is a developer with 15 years experience in real estate due diligence, acquisition, operations, and more. He's an expert on building new subdivisions, namely in Colorado, Northern California, and the Southeast. He has owned and managed over $100 million in projects in the past. And Rob's business partner, Jared Garfield, is a renowned speaker, notable investor, property provider, property management expert. He's also a real estate media producer and podcaster. In fact, I'm surprised it's the first time that we've had Jared on the show here because he's also worked as a rich dad coach. So together, Rob and Jared really are experts in identifying that path of progress to help build us out of this housing shortage that we have. They identified the time, the place, and the real estate product type. Rob and Jared, welcome to GRE.
Thank you very much for having us today, Keith. Keith, we're glad to be with you. I love listening to your shows. You always make such great points, and we're excited to be here today to talk about helping solve America's housing shortage.
Yeah, you guys are like today's heroes because there's evidence that a lot of builders are still producing below the demand levels that we have today inside this chronic housing shortage that we're already in. It's what you guys are doing that are helping bring us out of that. You've identified a residential market that has so many advantages in Colorado Springs, just about an hour south of Denver, for those that don't know. In the Colorado Springs metro area, that is one of the nation's hottest housing markets. In fact, over the last 3 years, I know there that average housing sales prices have increased 5%, 7%, and then 20% respectively. In fact, at the end of last year, the average property sale price was $437K there, so somewhat above the national median. And Colorado Springs has really attracted a lot of attention. As recently as 2019, U.S. News and World Report named it the #1 economy in America. And from 10 years ago, looking at the longer horizon, I know the home supply is down 92% in Colorado Springs. By 2050, which is less than 30 years from now, it's projected that Colorado Springs is going to be larger than Denver. That's what the Denver Post told us. So there are really so many reasons to be doing what you're doing right now. So tell us more about how you identified this need, which I think the need's pretty obvious today, and then this particular tract geographically.
One of the things, Keith, when you're talking about finding properties that make sense to invest in, it's all about getting really high returns. And if you're going to get really high returns, you want to make sure that you're buying in a market that's sustainable and that has a lot of strong growth. So there's a lot of things that we look at when we're looking to develop a subdivision is what's the absorption rate? How fast are lots or new homes moving quickly relative to the supply? That's real important. How fast are they going off the market? How many days on market do they sit before they get a buyer that immediately snaps them up and takes them under contract? How many months of supply are there that are sitting there, and how quickly is that moving off of the market? Those are key factors. How many building permits are being issued? Are there new shopping centers, new growth, new development, new 4-lane roads, new schools being built? A lot of those things are things that we look, and with Falcon, this area of Colorado Springs is the most red hot niche of the submarket of Colorado Springs. And Colorado Springs in and of itself was one of the hottest markets in the country. So it really was a great market to choose. And for an investor, these are the types of things that you really want to look at.
So I can say from the beginning of my relationship with Jared, I think we met 12 years ago, back in 2009, I believe. From the time that he met or was working with Rich Dad Poor Dad as a coach, he'd kept a spreadsheet of markets across the country, cities, and he'd kind of kept on top of that, comparing a number of different qualifications of the areas to determine which markets were good to go into for cash flow and other potential growth opportunities. Since I've known Jared, that's one thing that's been of interest to me is keeping on top of these demographics. We constantly look at what are driving different things. And so when this Colorado Springs project was brought to us, we dug in a bit more in that market. My father's a colonel in the Air Force. I have family close to this market. Jared has family members in the market. And so it was an easy transition for us to move into that market. We got a great team of people put together. One of the projects that we're going to talk about as a case study went under contract originally 4 years ago. And then we closed on it at first about 2.5 years ago. But there's so much to love about this market, which you've highlighted. But a lot of is really understanding a lot of these ideas that Jared just kind of said briefly, but absorption and upcoming demand and supply. And these are high level
job
market
growth, population growth.
Yeah. So that's how we ended up there. Was in this particular case, Jared had sourced it through a contact of his, but that's when we really dug into the market. But we love it. We're continuing to do a lot of work there and finding other projects there. And we've got a couple other main markets that we focus in, but this is Colorado Springs is fantastic.
One thing I would highlight, Rob, I think that's significant is you make money in real estate when you buy, not when you sell. You have to source the property right. And this was a planned unit development that a major national home builder had bought and gone belly up during the collapse of 2007 and 8. And so we were able to go in and rezone it and the county was thrilled to work with us because we were going in to do some really nice lot sizes where before they were going to be really small. And they felt that what we were going to have was going to be very desirable for the market and it fit their growth plan. But we picked up this land at a price that really raw farmland would have sold for 15 years ago. That's one of the key things that people have to understand when you're investing in real estate, particularly land development. You can't get caught up in the frenzy and pay a premium price just because there's so much demand for new housing. You've got to buy the property at the right price.
The seller in this case sold because they had bought it after Jared had mentioned this PUD that had been foreclosed on. So this person who bought it literally as a land grab to buy and hold it to sell it to somebody else. We were that somebody. So he bought it at foreclosure prices and then sold it to us.
And one of the great things for us is once we got into doing some due diligence, we found that a lot of the pumps had already been installed for the water treatment plants. They had already done some stuff on the wells that saved us a lot of money too, which really made the investment even more advantageous.
Yeah, that's terrific. And we talk about a case study for how to help alleviate the housing shortage. You, as developers, are being mindful that the market is more important than the property, just like an investor needs to be aware that the market is more important than the property before they buy. Tell us more about why Colorado Springs and some of the local drivers there to help continue it to provide this upward trajectory in the market and all this demand there in Colorado Springs.
One thing I would start with is livability. U.S. News and World Report not only ranked Colorado Springs as it alternated between number 1 and 2 for fastest growing markets, but it was also ranked number 5 for best places to live in America. So it's a very livable city. And so that was very desirable. But there was a lot of new development around. Meridian Ranch is a very large development that's close by, a master planned community and with several phases, and it was selling out red hot, and it was close to all the new shopping centers. You see new hospitals, new roads. I mean, everything was new in the last 3 to 5, 10 years, just new explosive growth everywhere. And that was part of what drove the decision is making sure that you're in an area where everything's really growing. And Rob had mentioned earlier that right now this zip code is the fastest selling zip code in the Colorado Springs market.
Yeah.
Additionally, there's about 30 Fortune 500 companies in Colorado Springs. You've got multiple Air Force bases, an Army fort there. You've got NORAD, the Air Force Academy, a number of different companies that have presences there, Comcast, Oracle, Lockheed Martin. Amazon just built a big facility at the airport, and they're building a couple of hangars there.
A lot of aerospace is there. And I like that the Winter Olympics training facilities are all in Colorado Springs, just because there's a lot of recreational opportunities. There's national parks. You've got Pikes Peak. And I also really enjoy the Garden of the Gods. It's just an absolutely beautiful place.
Yes, that Garden of the Gods is an iconically beautiful place. For those that don't know, there are these beautiful natural red rock columns that are sticking up all over the place. So a lot of people are attracted there for the proximity to the natural beauty. And then what you're doing to fulfill a need is that you are building on this over 800 acres that you have there. You're building a new residential community of single-family homes, somewhat upscale single-family homes. And I know there are more than 200 of them. I was reading about what you guys were doing recently. So tell us some more about that product type. Before I talk to you about how in the heck you build these days with the material cost increase and everything else, tell us more physically about what you're doing there and what you're putting in the ground.
Our builders actually that we're working with is Black Oak Homes. They won in 2019. Obviously, they didn't do it in 2020, but the Parade of Homes. In 2019, he won the Parade of Homes. Fantastic builder out there, really building a really quality product. We are in the path of growth as people are continuing to spread east and north, obviously between Denver and then east our way. And we're kind of northeast of downtown. Our particular product is in, a price range that's a little bit of the upper price range, but above 600 is where we're starting. But
okay,
that's basically the median home price in Denver. And you say, okay, you can get a house on 600,000 or for 600,000 on 2.5 acres. And it's bigger, it's very beautiful. I don't want to downgrade Denver, which is also a beautiful and lovely place to live, but you get a little more space to stretch your legs in Colorado Springs. So that's what we're doing out there. We've got these bigger lots, a nice community. We've got over 100 acres of kind of riding trails so that people can ride horses or bikes or whatever they want to do through there. Likely it's probably going to be horses. You have a lot of kind of hobby equestrians that are moving to that area where they'll have horses. They can have a little barn, have a couple of horses on the land themselves as well. So we see that fairly commonly.
As Rob alluded, Keith, one of the things that I love is there is a lot of in-migration right now where we're getting a lot of people that either get sick of the congestion of Denver as it's really grown and boomed, or they're just getting kind of priced out and they want to get away from the congestion and they want a little more lifestyle like Denver used to offer 10, 15, 20 years ago. And so they want to be hobbyists. They want to have horses. They want a little bit more land. This site is just an incredible site that has really good mountain views. And because of the lot sizes where we have 2 and 2.5 acre lots, people are able to have horses. They're able to do a lot there. But we're offering a little bit more for less, where a tract built home that was selling for the same price might be on a 1/4 acre lot or 1/3 of an acre lot. They can get a lot more space. They can have a little side barn. They can have some animals and, maybe have some 4-wheelers, but there's just a lot more space for the recreational enthusiast with great mountain views and great proximity to shopping and all the things that the growth sector of Colorado Springs has.
Americans want their space. Really, suburbia was largely pioneered in the United States when you think about it. So we're talking about these 3,000 to 5,000 square foot homes on large tracts of about 2.5 acres, really allowing for that expansive lifestyle. People from out of the area and people that want to get away from Denver are attracted to it. But I want to ask you guys more about the risk mitigation. How do you guys deal with this as builders today, as soon as we come back from the commercial break, with the market decline potential or material cost increases and everything from lumber to copper and land prices that are up as well? You're listening to Get Rich Education. We're talking about how developers bring us out of the housing shortage today. I'm your host, Keith Weinhold. The people that our listeners can't stop talking about are Ridge Lending Group and NMLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to 4plexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com. Starting in real estate seems hard for some. Even experienced investors can find it difficult to achieve the success that they had hoped for. What if there was one small change everyone could make that would solve these challenges? Allie Boone offers a book that really no one else has. It's an easy-to-understand glimpse into the real estate investing industry and your mindset. It's life lessons on hacking your mind before you hack your wallet. Her book to grab on Amazon is called Not Your How-To Guide to Real Estate Investing.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Rob Fuller and Jared Garfield about development of a project really meeting that housing need where we have such a chronically low supply of housing in this nation. And the developers like this, they really are today's heroes. We need to house people in this nation. But developers have had a substantial amount of challenges here in pandemic times with material cost increases and disruptions to supply chains, and especially high and spiking prices for things like lumber and copper, and then the land price and the labor price pressures. So how do you guys mitigate that risk as builders today? What do you do to deal with that and navigate through that?
One thing that we have to do is make sure that we've done our numbers very clearly and concisely, and that there's a profit that's in there. I mean, even things that you wouldn't necessarily suspect, like PVC, we've seen substantial price increases. There's a number of things that go into the ground that are costing that most home buyers don't think about. But as a developer, we think about because costs have gone up. Supply chains are broken and slow. So things that may have in the past taken 4 weeks to order, like windows, can now be 12 or even 16 weeks out. One of the things that we do is obviously a lot of that goes into good planning. We pay for the lumber and the windows. Basically, when we have a home buyer under contract, we put that money out, get on their schedule for trusses and windows so that we know we have it when we need it.
You lock that price in.
Yeah, exactly. So we know what we're paying for it when we enter into contract with that home buyer because we paid for it, essentially.
One of the things we alluded to earlier is the fact that we're not spec building. If we were spec building, there would be a bigger risk because if the price of materials shot up after we started building the house, we'd be in more trouble. But because we're costing it out at the time that the buyer wants to build it, they're actually paying for that increase because we're going to know the cost of the materials in real time at the time that we build that house for them.
One thing that we spoke about is land pricing as well. I mean, with this housing market the way it is, it's hot. The thing that people don't always take into consideration, it's been really, this problem started 12 years ago through the last recession. Banks that starting 12 years ago, 13, 14 years ago, even in some cases, weren't lending on land. And the recession has made it worse, where the laws that are there don't allow for lending, or the banks don't feel like they can lend on land. And so it's created this bottleneck for available lots, because you can only build a home where it's zoned and entitled and all the utilities are run to it. There's a lot that goes into years worth of work and preparation to get lots. So we can't snap our fingers today and say, here's 1 million lots to build on across the country to meet the demand that's there. To catch up is literally going to take years. And to take it a step further, it's not like I can go to a bank and say, hey, Mr. Banker, I need $10 million to develop this land. We brought in partners on the development side we've literally paid cash for the land development. We'll be into the land and development for $15 million, $16 million before we start building a home. And because of that, that makes that barrier to entry extremely difficult, extremely high. And so what we're offering, and to a number of investors are coming in, is basically, we're not saying, hey, come in and develop this land with us. We've done that. We're saying, hey, come in and offer construction loan for homes that we already have under contract with a home buyer with non-refundable earnest money in place, that's chosen the parcel they want, that's chosen the floor plan they want, the options, the upgrades, they're under contract and have that non-refundable earnest money. That's one way that we mitigate it. You've got big groups like big home builders, Lennar and D.R. Horton, and those guys. Those guys are public and have credit lines, $2 billion at 2%, right? That's one of the ways they mitigate it. Their cost of capital is so incredibly low, and their biggest asset is their workforce. We've had on other projects, companies like Lennar or other regional builders actually BRGCs as well. In this case, we're using Black Oak Home, which does, I think, a better quality product, I think, overall. But we've used these others for build to rent projects that we've done and things like that in the past. And we'll continue to use them in other markets as we do build to rent and things. Cost is obviously something you've got to keep under control. But one of the biggest ways you do that, I think, is knowing what you're getting into before you get into it and paying for it at that price that as you go in, so that you don't have later cost increases.
We talk about that history of financing difficulties for raw land over the last 12 years, Rob. Yeah, you've really given an explanation as to how we went from an oversupplied housing condition 12 years ago quickly into this undersupplied housing condition, and how pendulums are slow to swing. And it's going to take quite a while to bring us out of this. Can you speak more about the risk mitigation with so much uncertainty, especially on that supply side of materials?
And Jared may have more to say about this. One of the things that we've done with risk mitigation is we've looked at alternative building solutions. We've looked into steel and styrofoam construction homes, which has become popular. And really, a lot of commercial buildings are done with steel framing. Most people don't recognize that, right? But they'll do steel frame construction on commercial, which is typically a higher code than even lumber. People oftentimes think that, oh, well, steel, they're not familiar with it, but it's very common in the building industry. So that's one thing that we're looking at. But in the past, that's been prohibitively costly because it was more expensive. But now with lumber prices going up, it's kind of become par. But there are also advantages to that steel and styrofoam, that the R values, the insulation is higher, that you can create a product that, because of that, it's easier to install.
So they go up a lot faster. And that cuts down on construction costs. And so if your labor cost goes down, that offsets material costs going up a little bit too. So that's another way that helps with risk. If you can control the labor costs by using materials that go up a lot faster, sometimes that offsets. And then there's also contracts you can purchase that kind of hedge and act as an insurance if you wish to, for things like lumber and stuff like that, where you can kind of hedge against it.
It's interesting that if the lumber price shoots sky high like it has, well, soon people find substitutes, and then the prices for those substitutes can go up because there is the more demand for that, like, for example, with the steel.
Yeah, and sometimes if they go to the substitute too much, then obviously the price of the lumber may go down.
The cure for high prices is high prices, just like they say in economics. So tell us more about what you do with the funding side. You touched on it a bit with us, Rob, there, because you need to manage this property. You talked about the difficulty with more conventional financing for raw land projects before there are improvements there. So tell us about that funding side and how you get that done.
A lot of what we've done in the past has been friends and family, country club kind of money. I didn't belong to friends and family or country because I moved so much. My friends and family, my pool is shallow, and I didn't ever belong to country clubs. I'm an Air Force brat, but I've made relationships as time's passed. But that's a lot of what we've relied on. You know, that's kind of the phrase they use, friends, family, country club, but reaching out to people that we've known. And in this particular project, we have millions in already. And so we needed some outreach. And so we've kind of talked to a few folks that weren't in our tightest knit circle to open up the opportunity to them to invest in this type of project.
Tell us more about that. I took a look at you guys' financial projections. I see you do have a substantial contingency line in there for making this project profitable and yet still having enough of a cushion there for some of these supply and other disruptions like we talked about earlier. So how do you bring investors in and how does that work? Do you have a promissory note with them? Does one need to be accredited in order to participate?
We do accredited investors. Typically what we found is, and if people can invest $100,000 comfortably, that's kind of like the general rule. And so our minimum is $100,000 generally. Okay. Accreditation, kind of typically people are accredited if they're doing that. And that's one of the ways that you can kind of judge that. But we do a promissory note. We actually guarantee it from my personal and my business, as well as the project itself. There's a number of properties that we're building, and because we're building a number at once and we're moving from one to the next, because this is pretty fast moving. The market, as you can imagine, is, as we've discussed, very fast moving. So we're not leaning individual properties. We're doing the project as a whole and placing money as we need it and then moving it to the next one as homes sell.
And that means that you've got about $12 million in equity in the project backing it, in addition to Rob's personal guarantee.
What kind of a return are investors really looking for these days with a project like this?
Okay, that's a good question, Keith. So an investor in this project can expect for a $100,000 investment, a 9% return. It's tiered all the way up to 15% return up to $1 million. So if they invest $1 million, they can expect a 15% return.
When is return of principal taking place and then the return on the principal as well? Are there monthly payouts there? And then tell us about the duration.
The note is for 2 years. I anticipate that we'll pay it off early just because the way that the market's going, we'll have it paid off in a year and a half. But we did it that extra 6 months just to be safe. And we're setting everybody's expectation for that 2-year time frame. There's options for monthly payout and annual payout. Some people with their financial load, they don't want to have income coming in because they don't want to have extra taxable income, or it's going to their IRA, and having the money sit in their IRA doesn't do them any good. So they're kind of pushing it off till the end. So we've got a couple of different options, monthly or payoff at the end, just depending on the investor's choice.
And to make it real for an investor, even at that lowest investment tier of $100K with a 9% return and return of principal in a year and a half to 2 years, they would get a return on principal. If they're paid monthly then with a 9% return on a $100K investment, that would be $750 direct deposited into that investor's bank account monthly. Is that right?
That's correct. Yep. It's for a total of $9,000 for the year and $18,000 for the total duration.
Tell us more about how that investor secures things and has some collateral, or how that promissory note's structured.
So the promissory note is not secured on the individual property. Like I said, it's a pool. So we're building homes and then we're moving to the next home, rather than having to issue lien releases because you can imagine multiple people per property is how it's going to take if each person gives us $100,000. So for the smoothness of the project, we're doing a guarantee from the company and from me personally on this. I have several $1 million in this project. My money is guaranteeing their investment. That is buffer for them. If anything were to happen, my money would go first before theirs. But in addition to that, this return we've built in a huge cushion on the numbers you'll see. There's both lender and contingency numbers that we boosted way up to add extra padding.
One of the things I really like about it, Keith, is with returns between 9 and 15%, depending on how much you choose to invest. I think that one of the things that's really a strong, clear advantage to this versus the turnkey that Rob and I have done so much of in the past is you're getting an A-plus asset in an A-plus market instead of buying a C-class, working class, or Section 8 type of rental that might be a 1960s or 70s house for $180,000 and maybe getting a 9% return and having to deal with the headaches that come along with property management. This is pretty headache-free, and it's A-plus asset class. is the type of home that most of your investors would want to live in. And so I really like that you can get those kind of returns in A-plus class asset classes, because typically those returns are not that high on A-plus type of asset. You're usually looking at 5% or 6%.
Yeah, that is an excellent point there, Jared. So from the investor perspective, it really gives one an opportunity to diversify in a few different ways. You can diversify across product type with an A-plus asset. You can diversify into a different geography, and then it's a different income stream type because that investor is basically supplying debt rather than supplying equity like they would if they were buying a turnkey property. What Rob and Jared are doing here piqued my interest, a month or two ago. And you've got a great report that you made available to me that I'm making available for my audience as well at getricheducation.com/Colorado Springs. If this sounds of interest to you, it's not common to be able to come alongside professionals like this. In that report, it shows your long track record, shows more about the Colorado Springs economy and a site map and site drawings and financial projections and that all-important schedule of investor returns like I know any investor is interested in. And you even have testimonials from pretty prominent investors that you, the listener, have probably heard of before, and they state in writing the numbers that they've received in actual returns, not just projections. Again, you can get that report at getricheducation.com/Colorado Springs if that's of any interest to you. Rob and Jared, do you have any last thoughts about this project that you're building where you're really doing something more altruistic than developers usually do because we have such a chronic housing shortage? Any last thoughts?
I think one of the things I like to highlight is the security of the fact that with $12 million equity already in the project and all of the entitlements already done, this isn't a project that we have to wait for. This is something that we're ready to break ground in June, where we're going to be digging basements as we put the roads in. And I think that having $12 million in equity in the project is a lot better than security than an $1,100 security deposit on a C-class asset. So I just love A-class assets, diversifying into A-class assets with having millions of dollars of equity is a nice security.
We've been looking at this project, obviously, for years. We owned it, but trying to determine exactly which housing product we wanted to put on it. And we've talked about a number of different housing products that are available to us. To the east of us, there are homes that are over $1 million. The next parcel east of us that's building homes is Old West Ranch. They're over $1 million. We're just about 90 seconds from that Meridian Ranch that Jared recommended or mentioned earlier. One thing that came to me when we were discussing exactly which product to put on this, I wanted something that we could look at later and say we are proud to have built. And I really feel like this product that we're building is something where we can later look back and say, see, that housing development, that is something we're proud to have built, to put our name to. There's certainly times where we've owned hundreds of rentals in the past and sold hundreds of them. And we provided good service to the people who live there. But sometimes the headaches of tenant move in, then move out and fixing them out, it feels like a circus,
vicious cycle,
rat race. Yeah. Mm-hmm. This product and what we found through the last few years as we've built and sold newer product is, for me, a better peace of mind. I know that the product that's getting built, it's not like when we go into a rental home and we buy it and we first start fixing it. We generally do a good job, but it could be any slew of things that we didn't know behind that wall or in the foundation or something that we didn't predict, we didn't know despite our inspections and our experience. The nice thing about a new home build is that the price that's there is almost always within a few percent of what it is, barring lumber price increases, but we mitigate that by buying the lumber early on, right? This is one of those things where when we looked at it, we like the product and what we're building. We feel it's been for us at least a bigger peace of mind. And not every investor has that same perspective. And they'd rather to get that extra couple of percentage grinded out. But for me, I like this a little higher tier product, right? A little bit less problems than those other ones. And I don't mean to diminish anybody who's in a lot of those C-class rentals because we did those for a long time. But for me, it was a lot of work. We had hundreds of them. And we've sold those and moved into these building developing products that for me has just been so much more fun and less stress and strain and mental exertion. So we love it. We like that we're building a good product that people can love like we love. So.
Sure is the type of product that one can be proud of, and you can sure check out those designs and floor plans, motifs, and looks there for the development. Again, at getricheducation.com/Colorado Springs. Rob and Jared, it's been great learning about how a developer navigates in this almost unprecedented environment today and meets a need. Thanks so much for coming on the show.
Thank you, Keith.
Thanks so much. We appreciate your time.
Yeah, it's great to get Rob and Jared's angle here from that development perspective. Again, today we covered a case study of how developers approach homes built on site. In upcoming weeks, it involves different new build approaches to address today's housing shortage crisis. For today's show, the bottom line is that they're producing something that isn't only of low supply and high demand, but it is durable demand when you understand that it's for that primordial human need of shelter. What's interesting for you is consider that these are upscale single-family homes with prices starting in the high $600,000 range. It really caters well to horse lovers. Horseback riding trails are within the community. They have equestrian easements, optional barns that can be built on site for the residents. So, like Jared was iterating there, this is an A-plus asset class. Well, you know how it is. A lot of cash flow-centric investors have a heavy weighting of B and C class properties in their portfolio a lot of times. I am one of them. Well, with A class or even A plus class like we have here, which means the nicest of homes, if you want cash flow, well, forget about it if you want to be a direct owner of homes like this, because you might only get a 4/10 or 5/10 rent to value ratio if you had bought these homes yourself to rent to others. But the way to get cash flow here is to provide a loan to the developer when they're still under construction. And because of my relationship with the developer here, when you offer a construction loan for homes like these that are already under contract with a home buyer that has chosen their parcel and has already got the non-refundable earnest money in place, your return then, which is a cash-on-cash return, is either 9%, 11%, 13%, or 15%, depending on the investment amount. It is a 2-year total timeline. But like Rob said, they are efforting toward an 18-month payoff for you. So this could very well be a nice option for you if, say, you need to get a chunk invested that's sitting relatively idle, earning 0.5% interest at Ally Bank or perhaps in an IRA, and you are 25xing a 0.5% return here. Or if qualifying a loan, say that that's not a fit for you, well then this private lending could be a good option because there is no loan to qualify for here. You're the one making the loan. If it sounds at least interesting to you, check out what they've got going on at getricheducation.com/Colorado Springs, where you'll get really good material on the Colorado Springs economy, project timeline targets, the site map, site drawings, financial projections, including their contingency cushion in there, that all-important schedule of investor returns, and just how one's investment is secured. And I like it because it's not just a bunch of projections, but their actual track record is right near the top of the report for you. Like I mentioned earlier, there are testimonials from prominent investors in that report, names that you may very well have heard of, stating in writing the numbers that they've received in actual returns. Again, not projections. And, you know, depending on the interest level, you don't have to, but you may very well want to do an in-person investor site visit. And I might be there so that we could meet in person and take a look around. Yes, face-to-face, in person, in Colorado Springs, not over Zoom. We'll see about that. But as far as seeing the development progress yourself remotely, they also shoot and upload drone footage weekly so that you can monitor things that way as well. Of course, the project has their own devoted website too. Big thanks to our savvy real estate guests today. If this is of interest to you, I invite you to, again, get started at getricheducation.com/Colorado Springs. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, getricheducation.com.